40-year loans for a home are here now. New Res just announced a few days ago that they will be giving a 40-year interest-only loans for home buyers. That's big news in this market. As you know, home prices have really peaked. I think they have peaked. I've said that in 2018 that they peaked, but they've still gone up and up and up, and they seems like it's still gonna go up. So I say it with a grain of salt that we have peaked because it may go up another couple of years. Interest rates are higher than they were. Right now they're at about 6% fixed rate depending on who you talk to or which bank you talk to. But a year and a half ago, they were as low as 2.5%. So you had a big advantage if you were a seller buying homes at 2.5%. Inflation is high. It's almost 8% right now. So assuming you bought a car last year or this year, your payments are much higher than there was no inflation because everything has gone up. So all these adds to the pressure of homeowners trying to buy a home, or actually home buyers trying to buy a house, because it puts pressure on the mortgage payments. So why is it significant that the 40-year loan is here today? Well, let's talk about it. I'll talk about what they are, why they are necessary, and why they are good or bad for the buyers. So stay tuned. By the way, my name is Mike Patel. I'm with First Team Real Estate right here in Anaheim Hills, Orange County, California. I'm glad you're watching this video. If you're here coming for the first time, I would recommend that you subscribe to my channel. I come up with videos like these with market updates and trends and things happening in real estate industry on a weekly basis. So glad to have you here. Please subscribe. So let's talk about the 40-year mortgage and the impact on home buyers. First of all, let's look at home prices. As you know, they've gone up. In California, the median home price right now is almost $883,000, which is a lot of money. National median home price is about $440,000. So how and why is it important that prices are so high and the people cannot afford to buy? And this is where the 40-year mortgage loan or variable loans, which are also coming into play so the buyers can afford it. This is what we call creative financing. I'll talk about creative financing in just a moment, but let's look at why the banks are doing this. To understand what's happening in the market and how the lenders and the banks think about giving loans, it's important that we know the numbers of what's happening. So let's look at this chart coming from the California Association of Realtors. According to them, in Q2, in the second quarter of 2022, the homeowners affordability index was only 16%, which means that 16% of California households could afford to purchase a medium price home. That means in California, only 16% of the home buyers or homeowners. In the second quarter of 2021, the affordability was 23% in California. By the way, I'm talking about California because I am in California and I'm a member of the California Association of Realtors. In the second quarter of 2022, that affordability from 23% went to 16%. The median home price of California was $883,000 in the second quarter of 2022, and it was about $818,000 in the second quarter of 2021. So the prices have jumped. In other words, as far as the income goes, it takes approximately $199,000 of minimum income required to make monthly payments of $4,980 at a 30-year fixed rate mortgage of 5.39%. So in the quarter of 2021, you could afford a house of $883 if you had an income of $150,000. But in the second quarter, to afford the same house, you needed an income of $199,000. So as you can see, as the price goes up, the interest rate goes up, the inflation goes up, less and less people qualify to buy a house. So that's why creative financing comes into play. So what is creative financing? Creative financing has been around for years and years and years, and it's always there. But when the market really peaks and the affordability index really goes down, creative financing increases. As an example, a creative financing is your non-traditional way of getting a loan. If you go to the bank and there's a 5% interest rate, they're going to check all your documents, all the income, and they have a set guidelines on qualification. In creative financing, banks give leverage. For example, in the 2003, 2004, 2005 pre-crash of housing market, a lot of the banks were offering creative financing. But one of the example was I actually sold a house. I was a listing agent and the buyer's agent brought in a buyer. And when I looked at the qualification letter, I noticed that the interest rate was 1%. Yes, the interest rate was 1%. This was a variable loan. It was a 3-year variable loan adjustable to a fixed rate on the 4th year to 7% 7%. So the kicker is when the interest rates are at 7%, the banks or lenders give you a loan of a variable rate at 1% and you qualify at 1%, even though you cannot qualify at 7%, and the lenders knew that, but they qualified the buyers at 1%. So of course the buyer is very happy. They bought a house, and guess what? In 2 or 3 years, when the rate went up to 2% the second year and 3% the third year, and then it became fixed on the fourth year at 7%, they could not afford the house. So they were in foreclosure and short sale, and that was part of the reason there was a crash. So creative financing is very good for the buyers who want to buy a house, but it is also very dangerous. The other way of a creative financing is a lot of the sellers, when they sell income properties or investment properties or even regular homes, the buyer may have money to pay you $5,000 or $6,000 a month, but may not have qualifications because they had a medical issues or bad credit, or they filed for a bankruptcy, or they had a short sale. So the sellers did owner financing and became the bank, and that's good and bad, but that's part of creative financing. And as we look at today, New Res just announced a few days ago that they are going to be doing 40-year loan with 10 years interest only payment. That's a very creative financing, and we're going to look at those numbers shortly. On a side note, when lenders come up with creative financing, it is also a sign that the housing is slowing down. Now, yes, housing is slowing down, and one way you can tell how housing is slowing down, well, several things. First of all, lenders like New Res themselves, Loan Depot has laid off lots of their employees. JP Morgan, the housing division, lending division, has had massive layoffs. Redfin, which is a housing company, and Compass, they have laid off staff as well. So we know that the housing is slowing down. Now, I'm not saying that the home prices are going down. In fact, they're still going up. Number of sales of housing as of second quarter of 2022 and first quarter of 2022 is definitely slowing down. In fact, according to the National Association of Realtors, of which I'm a member, they are predicting that in 2022, there's going to be about 5.4 million homes sold, which is a lot of homes. But if you compare that same number to 2021, NAR is saying that in 2021, the number of homes sold was 6.1 million homes. So obviously, there's almost 600,000 less homes selling this year. So there is a slowdown. So the lenders have to come up with creative financing, because what that means is at the higher prices, at the higher interest rate, a lot of the buyers are not qualifying. So for the banks to keep their employees and to make profit, banks and lenders to make profit, they have to come up with the ways to have buyers who are on the edge of qualifying to be able to buy a house. So I'm going to go through 3 or 4 numbers that you can see how that interest only payment or the 40-year mortgage payment, how it differs in payments and how you can qualify easily, because it does make a significant difference in your payment and your qualification. So let's look at some numbers as far as the loans goes. So to understand how these numbers work and how it benefits you if you're a buyer, or to the lender, and see how they can be profitable and you as a buyer, how you can afford it, let's look at a scenario of a mortgage payment and compare the 30-year fixed interest rate and the 40-year fixed interest rate and the 40-year interest rate only payment for the first 10 years. So let's look at an example. Let's assume that you're going to buy a house for $500,000 and you're going to put 10% down, and then the interest rate is 5%. So this is a fixed rate. So your mortgage payment will be fixed for 30 years. So if your house is $500,000 at 5% interest rate and 10% down, your mortgage payment comes out to $24.16 per month. So that's your mortgage payment. Let's look at the same house, and if you get a 40-year loan, it'll be easier for you to qualify, because at 40-year fixed interest rate of 5%, at same 10% down and same fixed rate at 5%. Now usually that percentage of interest rate will vary, because if they're giving you a 40-year loan, they may increase it or they may decrease it depending on your qualification. So that's a variable number, but for this example, we're going to keep it 5%, same as a 30-year fixed. So that principal and interest comes out on a 40-year loan at $21.70 versus $24.16 per month on a 30-year fixed. Now let's look at the 40-year rate at 5%, and of course that 5% will in reality will go up or down when you actually buy the house. But for this calculation and for this example, let's take a 40-year loan at 5%, but this time it's an interest only payment. Like I told you, the New Res is giving 10 years of interest only payment. So what is your interest only payment on a $500,000 house at the same 5% interest rate at the same 10% down? Well, it drops to $1,875 per month the first month, which is almost $500 per month less. So you as a buyer with a $500 payment less easily qualify, where you may not be able to qualify for a $2,400 payment, but you will qualify for an $1,875 payment. So that's why the banks do a 4-year loan or adjustable rates, because they make money when you get a loan, because they make money and obviously they're in for the profit. And why would a buyer like yourself want to get a 4-year loan temporarily? Maybe you had a medical issues, or you had a bankruptcy file, or you had some unexpected student loans, whatever the case may be. Right now you want to buy a house, but because of a situation you are not able to buy, so you may opt for a creative financing like this one. But keeping in mind that in the long term these are not good loans, because you are paying more for your mortgage versus a 30-year loan, because you are adding 10 more years of interest. So you're paying a lot and you're paying for a long time. If you're 60 years old and you get a 40-year loan, you're 100 years old. You may not be around to pay off that mortgage, but that's a whole new situation. I'm just trying to give you the number. So the advantage is there for the buyers and the lenders, but there's also disadvantages. Hope this helped. If I can answer any questions, please make comments below. I'll be glad to answer any questions.